It's very nice to be here, at least virtually. I think last year I was able to get out to the neighborhood and present in a pool house. So this is slightly less ideal, but I'm very happy to have a chance to speak with the membership. So I'm here on behalf of Motus Insurance Services, and we're a broker and the developer of this currently unique earthquake insurance program. So tonight I'll talk a little bit about the background of the program, why it was developed, the problems that it solves. We'll look at in some detail the coverages that we offer at Rancho San Joaquin, and then we'll finish by walking through the enrollment form and otherwise give additional insight on how to make the decisions that go along with the enrollment process and how to actually enroll. So with that, let me step back a little bit into the background here. So the Motus Earthquake Insurance Program was developed to solve a major problem facing really the vast majority of California condo owners, namely those condo owners and associations that do not purchase a full coverage master earthquake insurance policy. That, by the way, is about 99% of associations in California. Very, very few associations buy a full coverage master earthquake insurance policy. In other words, a policy that would rebuild the entire association in the event of an earthquake. 100% have a full coverage master fire policy, 1% have a full coverage earthquake insurance policy. So you're certainly not alone in that in that state. But the issue and the reason why we exist is that when the association does not buy that full coverage master earthquake insurance policy, individual unit owners cannot purchase full coverage on their own. There is no product out there that allows an individual condo owner to fully insure their property. So that's really why we're here and why we developed the program. So very specifically, what do we mean by full coverage? Number one, full special assessment coverage. We'll talk about each one of these in more detail, but simply the dollar amount that is your share of rebuilding the entire association. Number two, you need coverage that extends not just to residential buildings, but to non-residential exposures, whether that's a pool house or a pool, or roads, walkways, underground pipes, and plumbing. You're not just responsible for residential buildings, you're responsible for those common areas. And number three, you need full ordinance and law coverage. Now, this one's a little bit in the weeds of earthquake insurance, and I will spend a little more time on it. But it's critically important. And I think once you see it, and even if you choose to speak with your personal broker, they will back us up. But these are the big three to us. You can't get any of these three on your own. If you go and look at a California Earthquake Authority policy, it's 0 for 3. There is no policy out there available to an individual that will do any one of these three. So this is really why we developed the program. And just a quick preview, what we do with the program is we design what would be a full coverage master earthquake insurance policy. And we work with the insurers who provide master earthquake insurance policies for HOAs. The difference between us and a traditional master policy is that we allow each individual unit owner to opt in to his or her share of that master policy. So instead of it being an all or nothing decision at the HOA level, where everyone pays and everyone gets the coverage, or no one pays and no one gets the coverage, we allow individuals to purchase their share of the coverage that they really need on their own without impacting the HOA budget. So that's why we developed, that's why the company was founded. This is our core product. It was approved by the Department of Insurance back in 2017, and we've been offering it ever since. We do have some associations who've been in the program 5 years. We have several hundred enrolled in the association or in the program at this point. But let's talk about some of these details briefly. Full assessment coverage. So I hope everyone is aware that if there is a major earthquake and whether it damages some residential buildings or all residential buildings, each individual owner, whether or not his or her building was damaged directly by the earthquake, will be responsible for a share of rebuilding the entire association. In other words, you don't just think about your home, you are a member of an association and you all have a shared responsibility to rebuild. So that assessment coverage is a big deal. Your special assessment exposure is your share of rebuilding the entire association. And now keep in mind that refers to the bricks and mortar, the improvements to the land. It's outside of the land value itself. So we'll always be thinking about your exposure as being the improvements to the land. That's different from the market value of your home, which will include the land value. The land is not insurable. The land is there no matter what. It may go up or down in value. But for insurance, we're talking about the improvements to the land. So that's the big exposure that we were primarily concerned with. And here's just a quick chart of the options out there. So we'll talk about your actual exposure at Rancho San Joaquin in a moment, but the most coverage that you can purchase for special assessments as an individual on your own is with the California Earthquake Authority, and that caps out at $100,000 of coverage. And I can tell you that is a fraction of your share of rebuilding. So that's the primary reason why we set out to build this program, is to be able to offer coverage that actually lines up with your exposure. Number two, as I said, inclusion of common areas and other non-residential exposures, because your special assessment will have a large portion related to repairing or rebuilding residential buildings, and CEA will cover that up to the $100,000. But it will exclude things like underground pipes and plumbing, or clubhouses, or pools, or really anything that's not a residential structure. So that's a big gap with every other product out there, and we've been able to fill that one as well. Number three, and this is the one I said was a little bit in the weeds of earthquake insurance, but it's a very important coverage, and that's ordinance and law coverage. So just to keep it brief, ordinance and law coverage is coverage for damage to the building that is not directly related to the earthquake. So what you see on the lower left here is a picture of a building. This is from New Zealand about a decade ago. Earthquake came through. It severely damaged the right-hand side of this building, not as much damage on the left. So for argument's sake, let's say it's about 50% damaged and would cost roughly half the replacement cost to repair. However, what that crane's doing in that picture is demolishing the entire building because it's been effectively red tagged. In other words, a city or county engineer has come through and said, you are 50% damaged. You cannot repair this. We're not willing to risk it. There being, for example, damage to the foundations we can't detect. You have to tear down the rest of the building and start from scratch. You pay for the demolition and you have to pay for the full rebuilding. That is not direct damage from the earthquake. Unless your earthquake insurance includes ordinance and law coverage, you will be financially responsible for A, the demolition cost, and B, rebuilding that portion of the building that was not damaged directly by the earthquake. So that omission, CEA doesn't include ordinance and law coverage. Other individual options don't include this. But that idea of a red tag is a huge issue because it's very unlikely for any structure at Rancho San Joaquin to actually fall down in the case of a major earthquake. However, it is much more likely that a county engineer comes through and says there's sufficient damage that you have to tear down the building. So unless you have ordinance and law coverage built into your insurance plan, you are on the hook financially for both the cost of demolition and the cost of rebuilding. So those are the big three. There are some other things that we built into our program, but those were our primary concerns, to bring a product to individual condo owners that allowed them to purchase full assessment coverage that did not exclude their non-residential exposures and that included full ordinance and law coverage. So that's really why we developed the program and why we're here. We're able to do this, as I said, because we use that underlying master earthquake insurance policy structure. It's a very it's a tried and true insurance structure that's been around for about 50 years. We simply allocate the benefits to those unit owners who enroll. When we do the underwriting to put our programs together, there's an added benefit, which is that we do full analysis of the risk at your location. The type of soil, proximity to a fault, year of construction, type of construction, and as a result, we're generally able to offer coverage at a fraction of the cost of the California Earthquake Authority. Because the CEA, the only input they have is zip code. Everything is based on zip code. And so if you plug in your zip code, they have to assume the worst as far as the rest of those variables, age of construction, soil quality, proximity to a fault, you end up paying a lot more. So that is that's the general overview of the program. I'm going to switch over to your materials and we'll talk through what we actually offer at Rancho San Joaquin. So this is our second year of the program. So I know there are some folks on who may already be enrolled, but a lot of folks here may be looking at the program for the first time. So let's start on page, it'll be page 2 of the materials that I hope you've received from the association. And really this
Alex,
is the core.
Yeah, I'm just going to interrupt very quickly. Everybody should be getting a copy of this in the mail any day now. So First Service had mailed it out last week. It's just taken a little bit longer than we thought.
Okay. Thank you for handling that. You'll see on this page, though, a quick summary of the program. Now, this is just a slice of what we offer, but just to look at how we tailor our programs for the associations we work with, and in this case, for Rancho San Joaquin, what we start with is an estimate of the total cost to rebuild the entire association. So again, that's all buildings, infrastructure like underground pipes and plumbing, common areas and common area amenities. We take that total cost and we divide that by the number of unit owners to come up with an estimated unit owner share or exposure. That comes to, with a little bit of rounding, to $350,000 at Rancho San Joaquin. And again, that number, the first thing that you should compare it with is CEA's cost at $100,000, or excuse me, CEA's maximum coverage of $100,000. So your exposure is more than triple what you can get outside of our program. This is first and foremost why we developed the program. Second line is annual cost. We don't have the cost for $100,000 of CEA coverage on here. I believe it's in the neighborhood of $350 a year. So that's $350 for about $100,000 of coverage. But of course, it's a lot less coverage in terms of cost per dollar of coverage. We are much lower than CEA. The third line here is the deductible. This year, we're making a 5% deductible option available, but I'm going to talk about the base program, which is a 10% deductible program. And I'll talk about how the deductible works when we get to the coverage options, because that's where I can sort of illustrate how the deductible impacts you as an individual. The rest of this column is really just emphasizing the completeness of our coverage. So we do cover your earthquake special assessment, and that will include any damage to residential buildings, to the infrastructure, to the shared amenities, all those, and of course the full ordinance and law coverage that I dwelled on for a little bit too long. The CEA will cover damage to residential buildings or those elements of the special assessment, but they will exclude the rest of these. Those are not covered by CEA, so those are only available through the Motus program. Now, another unique aspect of the Motus program is that in this 350 or whatever you choose, you can go higher, you can go lower as an individual, and we'll show you those options. But this amount, whatever you purchase here, will apply not just to special assessments, but also applies to your unit interior, including any improvements. So with most products out there, you will buy one bucket of special assessment coverage and then a separate bucket of unit interior coverage. Now that's not a great model because you may not know exactly where the special assessment exposure ends. In other words, how much of your unit the HOA will rebuild, including the interior, versus how much is going to be your responsibility. By eliminating that line in coverage terms, we're able to offer much more flexible coverage. So what this means is, if you buy $350,000 of coverage with Motus, that can go towards a $350,000 special assessment, or it could go towards a $200,000 special assessment and leave $150,000 for your unit interior. Again, it's flexible coverage, so each dollar of coverage can go towards those two major exposures that you have. Now, the interior is a fixed term when it comes to earthquake insurance and to your fire insurance as well, for that matter. It refers to any element of the unit that is permanently installed and also captures major appliances. So the interior will include your cabinets and countertops. It will include recessed lighting. It will include your washer dryer, technically installed in the unit. Where interiors, and it will certainly include any improvements you've made. So if you put marble flooring in throughout and upgraded all the bathroom fixtures, that's all included in this. Where the unit interior stops is with personal property, and we'll talk about that next. But essentially, think of the interior as being everything that stays with the unit when you move out, whereas personal property will be the things that you take with you. Clothing and furniture, small appliances. Again, talk about that in just a moment. So that's the core of the Motus program. This combined limit, special assessment, and unit interior coverage that is tailored to your association, designed around the association's cost to rebuild, and priced according to your actual risk. So this is the core of the program. Now we do offer an optional coverage that you can add on to that, which in this case is combined loss of use combined loss of use or rent and personal property coverage. So these are the other two exposures that are typically handled by earthquake insurance. Loss of use or rent means if you live in your unit full time, that's the cost of renting alternate housing while your unit is unavailable to be lived in. The rent portion means if you rent your unit to a tenant, this covers you for lost rent while the tenant is not occupying the unit. And then we combine that with personal property coverage. So the coverage that will apply to clothing and furniture, blenders, toasters, things of that nature. So in that case, of course, we have these two buckets that capture multiple things. And anytime you can buy insurance that applies to more categories of exposure, that's a positive for you, the insured. So again, the first and the main coverage, what is truly unique about the Motus program is the coverage up top, the 350 or more or less, but of combined limit, special assessment, and unit interior coverage. And then really, there are many sources of perfectly fine loss of use or rent coverage and personal property coverage out there, usually not combined, but that's the optional coverage that we add. Now, again, deductible buy down is available. We'll be talking about the 10% program, but you can take that down to a 5%, and we'll point you the right direction for that. But this is the core. We're going to be stepping into the enrollment form, where we'll talk about a few additional details, including the deductible. We'll talk about the actual financial backing for the program in a moment. But in terms of just the structure, this might be a good time to pause and see if there are any questions that I can answer right now, keeping in mind that I may put off those questions until a little bit later in the presentation.
If anybody has a question, you can unmute yourself and ask.
Okay, this is Paul Suler. I already have a policy. We've had it for about 10 or 11 months. Will we be sent invoices as the anniversary approaches?
Yes.
Okay.
Absolutely. Yep. So, and in fact, let me answer your question by pointing to this. If you are looking for renewal, certainly look for your renewal offer from us. We will get it to you by email. We actually will also send it by physical mail to your mailing address on file. So you should have that in the next week or so. We did launch this program or the renewal a little bit earlier, or the process a little bit earlier than normal. So our team is catching up with getting invoices out, but those will be on the way.
Thank you.
I have a question, if I can go next. This is Jim Shaw. And new to this this is a learning curve for us. So 2 questions. Who decides what percentage of the homeowners association is damaged? And if we go with the $350,000 coverage, and would we just get a check for repairing our portion? Oh, okay.
So it's a good question, and it is something that's worth considering. And this, of course, is outside of insurance. This is just good general knowledge to understand your exposure and how it works. If there's an earthquake, then the first step will be for the association to survey the damage. So bring in a contractor or inspector and look at what needs to get rebuilt. Consult with an attorney to see which elements of the association the HOA is required to rebuild, because this will be defined in your bylaws. Typically, the 2 major standards are bare walls standard. In other words, the association has to rebuild all residential buildings and common areas. Residential buildings up to and including the drywall is the bare wall standard. The other standard, which is more and more common, is the contractor's grade, where rebuild up to the state that it was when initially completed by the contractor. So they'll never repair improvements, but they may really fix up the entire interior as it was originally built under the bylaws. Once there's a sense of once the association knows what they need to repair, then they start to get quotes. And once they know how much the quote is to how much it will cost to make those repairs, then you go back with your attorney and consult with the attorney on how the association will pay for this. And in sort of the quick answer there is typically it's a pro rata special assessment. In other words, each owner pays an equal share of the cost of rebuilding, regardless of where in the association the damage occurred. So everyone in the association gets assessed. Now, as an individual with our coverage, that assessment is the first step. Once that's there, then we can really kick off the process. You'll look at that assessment. Meanwhile, you'll know how much of your unit will be repaired by the association through that assessment. You'll know you'll be able to bring in a contractor to give you an estimate of how much it will cost to make the additional repairs to your interior that you are responsible for. And that combination is the basis of your claim against our policy. So we don't get in the way of the special assessment process. In other words, the association does everything they would always do up to billing unit owners for their share of making the repairs. And then all unit owners who are part of our program, we are one large group making a single large claim to a commercial insurer. We will coordinate, Motus, we are the brokers, we'll coordinate that effort. And that is the claims process. So that's the general order of operations there. Does that answer your question, Jim?
Yes, for now. That's good. Thanks.
Okay, great. I'll take it. All right, well, on that note, why don't I continue on? I'm getting into the enrollment form. We'll certainly have other pauses for questions. I think those were good ones to kind of understand where we are. We're about to step into the enrollment form. It is a static PDF form, which by its nature means that it's got limited flexibility in terms of coverage options. and also limited in terms of payment options. So we'll walk through that, but know that you do have the option to sign up online where you can select additional coverage levels, intermediate coverage levels, higher and lower coverage levels. You can choose to pay quarterly or semi-annually, although additional fees apply. It's $8 per future payment. So quarterly, a down payment, 3 future payments, 3 times 8, excuse me, is an extra $24 for the year. And you can pay by credit card. The enrollment form assumes that you will pay by check or check equivalent. You can pay by credit card online, although we do pass through credit card fees of approximately 3%. So do be aware of that. But with that, let's step into the form itself. So obviously we are on the big dedicated webinar here. Glad to have you all on. There will be some additional events open to Rancho San Joaquin members. These are open webinars. In other words, many associations are invited to attend. So we won't be going through the RSJ materials. We'll be going through a generic version. But you're more than welcome to join if you'd like to ask questions in a live environment or hear questions that other condo owners are asking. And then we get to the enrollment form itself. So in this enrollment form, the top gray box is one of the most important. It's highlighted for a reason. First off, the issuing company. So Motus Insurance Services, we are, I mentioned it earlier, we're a broker. And specifically that means we developed this program. We got it approved by the Department of Insurance. Ultimately, we are on your side in all this. We sit on your side of the table. We coordinate claims. It's our job to maximize your claim recovery. The company that pays claims on this program is Palomar, and the entity is listed here. So Palomar is a large commercial insurer. The parent company is listed on NASDAQ. It is active in all 50 states. It's based in the US, actually based in San Diego. So this is one of the top companies that offers earthquake insurance to HOAs in the state of California. Their AM Best rating is A- excellent. If you'd like to read more about the financial backing of this particular entity, that is the best place to take your next steps. So to go to the AM Best website, which is ambest.com, and read up on the reasoning and the backup for this rating. The program has an effective date and an expiration date, and this comes from the idea that the program is built on a foundation of a master policy, which is designed to be a one-year term policy. So all of the coverage under the program for Rancho San Joaquin will start at 12:01 a.m. on October 5th and run for a year. This being a renewal, of course, if you're renewing, you'll have no gap in coverage. But for those looking at it for the first time, do be aware of that. This coverage does not start the moment that your credit card runs through our system and you receive your documentation. Your documentation will say that the coverage goes into force on October 5th. So do be aware of that. There's a deductible listed here. Again, the base program is 10%. You can drop that down. I'm still going to get to how the deductible works in dollar terms, so bear with me. Briefly, we'll skip through the next section, property owner information. The only thing worth dwelling on is the full name or the insured, which, as the asterisk says, you put in whatever you think should be at the top of your certificate of insurance. Look at your fire insurance for a guide. So it might be you and a spouse, might be you as trustee of a family trust. Whatever you would like to have appear there, that's what you should put in here, and you would do the same thing online. There's some guidance on the online system as well. The rest of this is your contact information, followed by the property information if it's different from your mailing address. And then we get down into the meat, which is the insurance coverage options. So as I said, 350,000 is an important number in the design of our program. So again, we take the total estimated cost to rebuild your entire association, which I think is just under 110 million. We divide that by the number of unit owners, and that comes up with an estimated average owner exposure. Two really important words in that: estimated and average. And this is where we start talking about different coverage levels. So we'll talk about the average first because that's a big deal. We do start with this 350,000, but you should consider your own exposure when looking at that number. Your exposure may be significantly higher. If you've made a lot of improvements to your unit, then you put in those marble floors throughout. You have gold leaf on the ceiling of your lovely bathroom, along with beautiful new fixtures and upgraded appliances, the latest and greatest Wolf range and Sub-Zero refrigerator. Those are expensive. If you've been through these projects, you know they're expensive. So if you would like to have insurance for those additions to your unit, that's probably the number one reason to consider more coverage. A secondary reason in most people's minds, but a very real thing, is the concept of surge pricing. This really is, this is on the estimated word. This is our guess, our estimate in a vacuum of how much it would cost to rebuild the association, translated into per unit owner terms. I will note, first of all, that it is the same as the number that we had last year, because these numbers are not updated on a real-time basis. And I think we're all very aware of what's happened on the inflation front over the past 12 months. So consider inflation, but more importantly, consider what would happen if a major earthquake strikes the Orange County or greater LA area. You will not be the only entity in that case hiring a general contractor. You will not be the only entity trying to buy building materials. Costs will go up. We've seen it after wildfires up and down the state. And if the cost goes up by 50%, your special assessment will go up by 50%. And the way to insulate yourself against that is by purchasing more coverage. But with that said, the amount of coverage that you purchase is the driver of your deductible exposure in dollar terms. This being a 10% program with a 5% option, but a 10% program, if you buy $350,000 of coverage, you should assume that your deductible is $35,000. It is not, the deductible, I repeat, is not based on your financial damage. In other words, if there's a little tremor and everyone in the association gets a bill for $100 to fill in some cracks to the sidewalks, this insurance is not here to pay $90 out of that $100 assessment. This insurance is there to pay for 100% of the cost once you've exceeded the deductible. And again, the deductible is a percentage applied to the amount of coverage that you purchase. So while you may be, if you're thinking about $350,000, but also thinking, well, I did spend $100,000 on a renovation, might be going with $450,000, then there is a $10,000 difference in your deductible. It would go from $35,000 up to $45,000. So be very aware of that. Once again, the deductible is based on the amount of coverage you purchase and not on your financial liability. You'll see some slightly peculiar things when you look at the pricing here. This $250,000 level that we offer, you can see it's not a huge step down from the $350,000. That's because this is considered partial coverage. So once you go below the estimated average, there's some math there's a curve applied to the pricing. So you don't get a huge discount when you decrease coverage. It is linear as you go above 350,000. So you can step that up to 450 or 400,000 online, 500,000, 550. And if you want higher limits, you should just give us a call. We'll happily help out. But again, I mentioned it earlier, we want to make sure that no one purchases coverage thinking they need to cover the market value of their home. That is not what you should look at as a benchmark. You should look at the portion of your home's value that is bricks and mortar, really. So that's a common misconception. Moving on to the combined loss of use of rent and contents coverage, we offer two coverage levels here, 50,000 and 100,000. It is a 10% deductible. The buy down does not affect that. I didn't mention that at 5% deductible buy down in those numbers, but just to be clear, if you buy $350,000 of coverage at 10%, deductible is $35,000. If you pay extra to go down to the 5% deductible, your deductible goes down to $17,500. So you'll see online that it adds a real cost to that, because you're talking about the lowest levels of coverage. It's an expensive option, but it is available this year. So do have a look, and our team can always help you look at the pricing difference. But sorry to go back, combined loss of use for rent and contents coverage, that is a 10% deductible. There is no buy down on that. So it's simply a deductible that is 10% of the amount of coverage that you purchase, meaning if you have $100,000 of coverage, then the first $10,000 of lost personal property or alternate housing cost, that's your deductible. Once that's met, once you pay that $10,000 out of your own pocket, then the next $100,000 will be covered by the insurer. Note in that statement that the deductible does not decrease your maximum recovery from the insurer. If you buy $100,000 of coverage, you can still get $100,000 back regardless of the deductible. The deductible simply comes first. So don't look at that 100,000 and think, well, it's 10%, I'm only getting 90. That's not the right way to think about it. Deductible simply comes first, and then the insurer is on the hook for the full amount purchased. If you're purchasing with this, using this form, simply check off the boxes of the coverages that you would like, add up the annual total, and send it in to us in our office here in very earthquake remote New York. And we will acknowledge, send you your forms, and you will have all that in your pocket. We send them electronically, by the way, and that's how we recommend you keep them. It's not very helpful to have your earthquake insurance policy sitting printed in a building that you may not be able to access after an earthquake. So do make sure to keep that in the cloud. If you want to sign up online, I didn't mention how to get there, but it is listed on that second page, and also here. You would follow this link, go to app.motusins.com, and then use your HOA code, which is RSJ 612. The 612 does come from the end of your zip code, so hope that's easy to remember. Once you put that in, you can register, you can look at different options available, look at the pricing differences for intermediate coverage levels and different payment plans. And if you have any questions at all, please contact Motus. So we are, I am part of the New York team, but the majority of our employees are in California. I'm a California kid. I grew up through Loma Prieta up in Northern California. I just went to Pomona College, not too far from you guys. I guess just a little north. So I'm a native son. I've just been in New York for a bit of time now. But the team, as I said, predominantly is in California, a mix of Northern and Southern Californians, and we are here to answer your questions. So the toll-free number you will see at the bottom of every page, 833-668-8746. If you prefer, email us at info@motusins.com, and we will get back to any questions that come into us that way. And with that, I'm at the end of what I wanted to get through. So from here on out, this is your time, and I'm happy to answer any questions at all.
If you'd like to ask a question, just simply click on the unmute button at the bottom of your Zoom screen.
So I have a question. It's Bob Watson, 19 Palace. I bought this last year. It expires October 21st this year. And do you send me a renewal, or do I have to go back in and re-sign up?
You'll get your renewal invoice for the same coverage level, and it might suggest that you have other options available, but those will be sent out by email in the next week, and also by physical mail. So it'll take a little longer to get there.
Okay, and will that? I think the 5% deductible is a new thing.
That's right. The 5% deductible buy down is a new option. So that's we won't send you an invoice for that, but we'll make a note that you do have that option if you'd like to explore.
All right, thank you.
Anybody else? Going once, going twice. I think, Alex, you must have done a very complete job here.
That's what I take away from this. Yes, thank you, Mark.
Okay,
Well,
and I'll just mention everybody that everybody should be getting a copy of this enrollment form along with information in the mail. First Service has sent it out last week, and we all should be getting a copy any day now in the mail.
And in the meantime, as I mentioned a couple times, and I'll say it one last time before I sign off, our phone number, our email address on every page here. So you have full access to us. I think I saw our website was, Mari, maybe you put that up earlier, but you can always explore our more information at motusins.com. That's our webpage with a big long FAQ and some other information, a few videos, mostly starring yours truly. So if you haven't heard from me already, enough from me already through this, you can always go there for more recordings.